Southwest Airlines has recently made headlines with layoffs, raising concerns about the company's financial health. But here's the big question. Is Southwest overvalued at its current price? Today, we'll break down the facts behind the layoffs, analyze the stock price action, and reveal its true intrinsic value using my discounted cash flow analysis. Spoiler: the stock may be trading higher than you think it's worth. Hey everyone, welcome back to the channel. Today, we're diving into Southwest Airlines. The airline has recently announced layoffs. Globally, 15% staff will be affected, first of its kind in 53 years, leaving investors wondering what this means for the company's future. In this video, I'll break down the key facts, look at recent stock price movements, and take you through my updated DCF analysis to uncover the true value of Southwest Airlines. Should you hold, sell, or wait for a better entry point? Stick around to find out. Let's start by discussing the recent layoffs. Southwest is facing significant challenges, from rising fuel costs to increased labor expenses and operational disruptions. These pressures have forced the airline to cut staff in an effort to stabilize its cash flow. Airlines across the industry are dealing with similar issues, making it a tough time for the sector overall. But how does this impact Southwest's financial health? Now, let's take a look at the stock price. As of today, Southwest Airlines is trading around $30 per share. That's a bit higher than where it was just a few weeks ago, but the question is, does the current price reflect the company's true value? This is where my DCF analysis becomes a bit tricky. Typically, I require the most recent year's free cash flow to perform a discounted cash flow analysis. However, Southwest's free cash flow has been negative for the past few years, and continuing to base my DCF on negative free cash flow would result in an unrealistic valuation. Ideally, we wouldn't want to see 10 consecutive years of negative free cash flow, as that would signal a serious issue for any company. However, analysts are projecting Southwest's free cash flow to turn positive in 2026, with an estimated $789.7 million in free cash flow. This projection, while a couple of years out, seems reasonable given that Southwest's management has shown resilience, especially during the pandemic era, where they successfully navigated one of the most challenging times for the airline industry. So, using this 2026 free cash flow projection as our base, I've applied a 4% growth rate from 2027 onwards, with a terminal growth rate of 2% and an 8% discount rate. The intrinsic value I've calculated for Southwest Airlines comes out to $24.70 per share. Given that the stock is currently trading at $30, it suggests that Southwest Airlines might be overvalued at this point in time. But what does this mean for investors? Before we continue, if you're finding this analysis helpful, make sure to hit that like button, share this video with others, and subscribe to the channel for more stock insights and personal finance tips. Now let's talk about management. Despite the negative free cash flow in recent years, Southwest's management has shown resilience in navigating turbulent market conditions. They've managed to keep the company afloat during the pandemic when airlines were among the hardest hit sectors. One positive note is that Southwest's net income remains positive despite the cash flow challenges, showing that management has maintained profitability in the core business. However, it's important to recognize that net income alone doesn't capture the whole picture, especially when the company is spending heavily on capital expenditures and grappling with operational disruptions. These factors have squeezed free cash flow, but with management's history of successfully turning the airline around, there's hope that the upcoming fleet upgrades and strategic cost-cutting measures will push free cash flow back into positive territory. Despite the current price being higher than the intrinsic value, there are still some bullish signs. Southwest Airlines is expected to return to positive free cash flow by 2026, and it continues to maintain a strong brand with loyal customers. The airline's competitive positioning as a low-cost carrier gives it an edge in the market, especially as the sector begins to recover from recent disruptions. But on the flip side, the risks are significant. The airline industry is cyclical and heavily impacted by external factors like fuel costs and labor shortages. Investors should be cautious about Southwest's near-term financial performance, especially with negative free cash flow projected for 2025. So, what's the best move for investors right now? Based on my discounted cash flow analysis, with an intrinsic value of $24.70, Southwest's stock is currently overvalued at $30. If you're a long-term investor, it might be worth holding off on buying more shares until the price falls closer to its intrinsic value. A potential entry point could be in the low 20s, where the stock would offer a better margin of safety. For those already holding the stock, you may want to consider holding on if you believe in the company's long-term recovery, but be prepared for some short-term volatility. If you're concerned about near-term risks, trimming your position or selling could be a prudent move. In conclusion, Southwest Airlines faces some challenges in the near term, but its long-term potential remains. With the stock currently trading above its intrinsic value, it's essential to be cautious and make decisions based on your own risk tolerance and investment horizon. If you found this analysis useful, don't forget to subscribe and check out this video here for a deeper dive into how industry risks could impact Southwest in the future.